Hello, I'm Mark Patton. During this educational video, I'm going to discuss balancing risk and return as it pertains to your investment portfolio. I think that for investors, this is extremely important to understand, and one of the premises here is that getting slightly better long-term rates of returns in a portfolio can add up to a huge pile of money, and I think we lose focus of that, and some people get too conservative. So I'm going to share with you some analysis and math around this to give you an idea of what these small incremental increases in returns can mean to a portfolio over a long window of time. So with that, I'm going to use a tool on our website that we call our portfolio analysis tool. And here what I've done is I've selected four different model portfolios to put side by side. So these are four of the five portfolios that we make available to participants in the retirement plans that we advise on. So you'll see conservative, moderate aggressive, and then there's an aggressive portfolio that we do not have on the screen. So these are portfolios 1 through 4, and you can see how they're allocated across U.S. stocks, international stocks, and so forth. And essentially, the left one is the most conservative, of course, and the right one is the most aggressive. So let me share with you some long-term rates of returns on these portfolios. So when we look at these portfolios, we've got data going back to the early 70s, and you can see that these portfolios, obviously, the more risk that is taken in a portfolio, the higher the expected return that we expected to return. There's no guarantees, of course, but historically, the more risk that has been taken, the better the long-term rates of returns. So you can see these portfolios range from about a 7.5% compounded rate of return on the left-hand side, 8.4, 9.1, and 9.9%. And when you look at these, a lot of times these numbers don't seem all that much different, and people tend to then get too conservative because they say it really doesn't matter if I get an extra 1 or 2% rate of return. Well, that's not the case, because getting an extra 1 or 2 percentage point rate of return over a long window of time can add up to a huge pile of money, and that's what I want to reinforce. Let's first take a look at the risk profile of these portfolios, and there are a lot of different ways that we can measure risk. But I think the most important is to look at what the losses look like during market downturns or bear markets. So what we've got here in this particular report is data showing us the performance of each one of these portfolios during the past bear markets. So let's take a look at this table down here. So this table shows us the date range of every bear market that has occurred. The most recent bear market was from a high point in October of 2007. So that was right before the financial crisis of 2008. And then the low point was February of 2009. So that was the most recent bear market that we went through. The one before that was the tech wreck of 2000, and that was the market peaking in March of 2000 and then hitting a low in September of 2002. So that was another bear market. So these are all the bear markets that have taken place since the early 70s. You'll see here U.S. large cap. That is the U.S. stock market, large U.S. stocks, and you'll obviously see significant declines during each one of these because that's the definition of a bear market, is when U.S. stocks have gone down significantly in value. So this is the performance of large U.S. stocks. So here we now have the performance of these four different portfolios. And what you'll see is that during these windows of time, each one of these portfolios did a great job of reducing the losses during these bear markets. So take, for example, during this first bear market of from 72 to 74, U.S. stocks, the U.S. stock market lost, large stocks lost almost 43% of their value. And this moderate aggressive portfolio on the right-hand side, it was only down just a hair under 20%. You can see the more conservative portfolio then lost less money and so forth. So you can see these losses during these bear markets. So what I want you to do is to take a look at these numbers, and I really want you to think about whether, what's the greatest loss that you can tolerate? What emotionally, how much loss can you tolerate and stay the course, through a bear market? And so over here on the right-hand side, this moderate aggressive portfolio, it's going to have experienced the biggest losses during these bear markets because it's the most aggressive portfolio. But as we already looked at, it also produced the highest long-term expected rate of return. My goal is to help you get the best long-term expected rate of return, but we need to make sure that you can tolerate the risk along the way. There's no guarantee about what the next bear market looks like. I have no idea. They're all different. You can see the returns during all these bear markets were different from one another, so there's no guarantee about what the next one looks like, but we certainly do expect that a diversified portfolio will help mitigate risk. The question is, how much risk do you want to take? How much are you willing to take to get the best possible long-term return? So I know that those incremental returns don't look like they add up to much, but they really do over time. Now you've got an idea of what the risk profile starts to look like for each one of these portfolios, and you can certainly pause this video and take a close look at this table. You can also click on these, by the way, and it'll show you a line graph of what each one of these portfolios looks like during each one of these bear markets, so you can see some additional details there. So now let's take a look at the final report that I want to share with you, and it's called the growth projections. And this is going to show us the impact of getting these incremental rates of returns over time. So again, as you might remember, that conservative portfolio produced about a 7.5% compound rate of return, the most conservative that we looked at. And then that moderate aggressive portfolio, the fourth one, produced a return of about 9.9%. So it was about a 2.5 percentage point compounded annual difference over time. And sometimes to investors it doesn't look like much, but what we're going to show you here in these calculations, and it's doing a lot of calculations for us, what it's going to show us in these calculations is that the impact, the amount of money that you can accumulate by simply getting a 1.5, 2.5% compounded annual better rate of return over a long window of time. And what we're looking at is 30 years. Over a 30-year window of time, the accumulation of money as a result of these small incremental rates of return improvements is substantial. Here we've got it. So you take a portfolio that today is a $100,000 value. That is the starting value is $100,000. I just randomly picked that. So you take a $100,000 investment today. You look at that compounded annually over 30 years, invested in these 4 different portfolios. Take a look at the average portfolio value for each one of these. So that conservative portfolio would grow to approximately $1.2 million. So $100,000 goes up to approximately $1.2 million in 30 years from now invested in that conservative portfolio. That moderate conservative portfolio, the next higher risk portfolio, $1.5 million. The moderate, $1.9 million, and that moderate aggressive, $2.3 million. So take a look at that. The difference between getting a 7.6% rate of return here and a 9.9% compound rate of return over here is the difference of almost twice as much money, nearly twice as much money by simply getting a 2.3 or 2.4% compounded annual better rate of return. Furthermore, if you look at the worst case scenario over a 30-year window of time, the worst case scenario, which is this minimum ending portfolio value, it's actually even better for the moderate aggressive, even the worst case scenario. So bottom line is these incrementally better long-term rates of returns can add up to a huge pile of money for investors. I encourage you to take as much risk as you can tolerate. I don't want you to take too much risk because during a bear market it will be painful and you're going to need to stay the course during a bear market and ride it out. You're going to need to weather the storm to get these great long-term rates of return. So don't take more risk than you can emotionally tolerate or financially handle, but take as much risk as you can because it positions you for substantially more money over a long window of time. So I hope that you have found this helpful. If you've got any questions at all for me, here's our phone number and our email address. You can reach out to us at any point in time. I'm happy to discuss this or any other questions you might have about your retirement and investment needs. I hope this has been helpful to you. Thanks a lot.